We're back with another edition of Super Prime UK. For those of you that haven't subscribed and want more data and more intel, here are the details below. Please reach out. James, Liberation Day week. The world is all eyes on America. How are we doing?
Yeah, it's been a tough day for those that work in the financial markets and any of those things which are commodity markets, volatility there. Thankfully, the property market is not a volatile stock, and there's a little bit more stability there. But just wanted to talk about today, focus on super prime London property. So, super prime property, we're generally referring to 10 million plus flats, houses. Super prime property represents, in terms of value, around 5% of all the UK property value, but as a proportion of the housing stock is an absolutely minute percentage, 0.0001% of all the housing stock as a number, but in terms of value makes up a huge proportion relative to that. Politically, Rob, Liberation Day, but in the UK now we've had two budgets from Rachel Reeves, whereby property tax and wealth tax have carried some enhanced burden. There's been some changes there, and there's some more changes which will come later this year and over the course of the next 24 months. One of the main concerns for the super prime London real estate is the abolition of the non-domicile status. And although that's a particularly popular politically decision, does carry risks both for the UK and London property market, the super prime market, but also how that feeds into the UK economy as a whole. I think the UK government, there's some clear concern over economic growth in the UK. The government's been pushing some of the large infrastructure projects which are looking to kickstart and pump money into the construction sector and have that multiplier effect ripple through the economy. But like we said, how are all these taxation decisions going to reflect on the super prime London property market? Generally speaking, in the past few years, when the UK economy has needed a little bit of a boost, that the government has fallen on some stamp duty inducements to try and bring people into the market. As we've had some tax changes, Rob, from the relatively new government, I don't think they're going to maybe dip into that. So it would be a little bit of a U-turn from where they're at. But how is that going to affect the growth, and where do you think we are?
Yeah, agreed. I'd say, unfortunately for the marketplace, I don't see that there is going to be a U-turn there in the short term. What is really important to understand, and let's be really clear, in our market, in our space, there are three clear main drivers. What are those drivers? So one is interest rates. It's the area that fuels activity, refinancing, acquisition, leverage, and that one driver is moving in the right direction. Will we have 2, 3, 4 decreases on the base rate this year? Let's wait and see. Hopefully, in a positive way, we get the 3 or the 4. Some analysts and economic commentators think it will be nearer the 1 and 2, but positively, if it's 3 and 4, that will be great. The second driver is jobs, and the job market is good. If the job market's good, people are able to pay their bills, people are able to spend, even though obviously we're on the back of high inflation, which is now coming under to a relatively settled position, or more settled. And the third driver is supply. And actually supply is now improving. Yes, in the UK, we've got this supply and demand equilibrium that has allowed pricing to remain high, and there's this shortage which the government are really focusing on their growth in building stock, which won't happen anytime soon. That takes years to get into the system. But in terms of stock in in our space, and prime, super prime, there is more supply coming on stream, not an oversupply on the back of the supposed huge exodus of everyone leaving. That's because some of the people that have been leaving are renting their properties or leaving their properties. It doesn't mean just because they're leaving the UK, James, that they're selling their property. I think that's quite important to distinguish the nuance between leaving the UK for tax reasons, but keeping your property or renting your property. So it's good to break down that. So the three drivers, to be really clear, are supply, interest rates, and jobs. All three look relatively good for 2025, which gives the platform for an upturn in activity.
Yeah, no, thanks, Rob. So three really interesting drivers there. I think how that applies to the super prime sector is that most of the market has a real necessity for that, the mortgage debt, for the job, and then for the supply. If there's a need to move home, to upsize for families, to maybe downsize. And with the global mobility that the ultra high net worth individuals have, they just don't have that same necessity in those three drivers, which obviously has a multiplier effects throughout the whole economy and what moves the property market. So really interesting to digest those three drivers.
And let's be clear on the interest rate position. Super prime lending is up in the first quarter by about 25-30%. That will grow throughout 2025 as debt becomes cheaper. Why is there a demand? There's a pent-up demand because the cost of borrowing has been so high for the last 2 or 3 years since the Liz Truss affair. And now that the cost of borrowing is coming down, the unleveraged super prime assets from Mr. and Mrs. Ultra High Net Worth are being taken advantage with some really good product that's in the marketplace currently with high LTVs and better pricing, and that market should perform. So the lending market in super prime UK this year will perform well and be a really good improvement on previous years.
Thanks, Rob. So in terms of the ultra high net worth individuals, these wealthy individuals, they're exploring some alternatives to London in terms of, we spoke about just a moment ago in terms of their global mobility and where their global homes are located. Italy, southern France, Dubai in the Middle East, Singapore, some of these other affluent cities whereby there's, comparable to London in terms of the amenities that they offer. However, I think it'd be a real mistake to perceive this as maybe a permanent exodus from the UK, or maybe an upheaval of a huge proportion of those ultra high net worth people. So I just wanted to present to you, Rob, how you're seeing this net migration.
Yeah, I think again, people focus on the pure migration and exodus of the ultra high net worth, and they don't focus on maybe incoming inbound migration that softens that position, and ultimately maybe the net position won't be as drastic as the numbers we're being told and are floating around the media. So my catchphrase, uncertainty is the new certainty. It has never been more true with the volatility that we're seeing across the world globally, but in many other countries, the US currently, Turkey, certain Middle East, Russia, Ukraine, etc. So sometimes we're very inward facing in the UK. We just focus on ourselves, and sometimes what a bad job we do here. All of that really needs to be put in context, because the rest of the world isn't doing the best of jobs either. And so actually there is still a good positive demand for people coming into the UK. Again, we discussed it before, there's a flow of US professionals that are looking to be based now in London, and that's going to be really positive for the market. And then again, you've got the Middle East, the Far East, and maybe something from Turkey if this uncertainty increases. So a lot of positive inflows that are supporting the prime and the super prime markets that will have a good impact on our marketplace in 2025.
In terms of the perceived, let's call it perceived turmoil here in the UK, they're drawn to the economy or to tax. It's not the same level of turmoil which we've seen in some of those other countries, which do have a high number of ultra high net worth individuals who are looking to exercise that global mobility. Maybe have an actual net migration to London and the UK. So an important reflection there, but also maybe an open question, Rob, but how tax sensitive are the ultra high net worth individuals? I guess it comes back to that turmoil and what is important to them and where they want to settle, either if it's permanently or on a non-domicile basis.
Yeah, interesting question, James. I think what a lot of people miss out on is the core fundamentals of why Mr. and Mrs. Ultra High Net Worth might either want to remain in the UK or be attracted to be here. And the piece around education, culture, architecture, quality of living, there's a real attraction to growing and raising a family in London with a lot of positive upsides and a great offering with the school systems. And on many occasions, that overrides any tax gain or implication that a tax regime might have, because people are family focused first, and what's right for their children and what's right for their family comes before everything. And if London is the place to raise your children or send your children to school, and you're in that process, possibly you're not leaving that process for tax reasons. You're rather going to focus on the needs of your family and the schooling and the education and the beautiful real estate that London has to offer.
Yeah, no, thanks, Rob. And I think that's completely right. Many international buyers and ultra high net worth individuals, they will prioritise proximity to top schools over their absolute tax efficiency during a certain, threshold and period of time. Rob, let's just reflect on some figures, facts and figures for the super prime. So, 2024 was a little bit of a lull in the market in terms of super prime 30 million plus. There was only 10 sales above 30 million last year, and if we compare that to 2023, there was 38 sales over 30 million. So as we can see, quite a big drop off in 2024 in terms of activity of that real super prime space. So where are we for 2025? It's been quite a good start to the year in terms of, Rob was alluding there, in terms of ultra high net worth mortgage debt and borrowing is up. Roughly about 24 10 million plus sales in Q1 so far. So that highlights activity in the market and highlights that deals are taking place, that they are transacting, they are happening. Still, I'd say less so on an off-market basis, Rob. There's a little bit more transparency in the market just in terms of where we are, but the deals are still taking place. In terms of the makeup of those transactions, I'd say demand for houses does continue to be stronger than the flat market, whilst lateral space within those houses and also outside space is at a huge premium. And that's been highlighted with a number of transactions which we've seen and been involved with and acted on. That particularly shines through on any best-in-class assets, which are generally showcased by the detachment, the lateral space, and the outside space, and ultimately location. Like we said, although buyers, we've seen a strong preference for the turnkey houses, the luxury apartment and branded residencies, Rob, have maybe entered into that market the last 4 or 5 years, and strongly underpinned the luxury pied-à-terre market in terms of where those ultra high net worth individuals are acquiring homes, having a base in different cities. And whilst this market, in terms of the flat market with the house market, generally the house market is exceeding that. the luxury and branded residency flats, there has been a few 100 million plus sales, which obviously makes up a proportion of those £100 million transactions which we see every year, which are in a fairly small number.
Super prime and prime transactions in branded residency has globalized real estate like other commodities, and having a third, fourth, fifth, and sixth home in New York, Paris, London, Madrid is more common now than ever before, and that trend is forefronted by a lot of the activity in London. Yes, it's been a challenging period. Acquisitions at the highest level have slowed down, more based on the market conditions and the economic environment and the challenging conditions of the volatility and uncertainty that is being faced. And the positive signs are that the refinancing and the lending market is improving and will do quarter on quarter as liquidity on those assets and leverage on those assets takes place, which in turn we can hope leads to more transactions and more money coming into the market. And that's really the outlook and the hope for 2025 as we see it closing out quarter one and moving into quarter two.
Thanks, Robert. Just in terms of the debt market for the super prime and how the market performs generally, there's generally an equilibrium between the two, and they normally mirror each other in terms of proportion to debt to the amount of activity. But I'd say there's a slight imbalance in terms of the buoyancy of the super prime debt market versus the actual current market activity. And I do think that the current buoyancy in the debt market could give some impetus in terms of the activity in the super prime sales market.
Yeah, I completely agree with that, James. I think the pent-up demand in the borrowing within that space, because the costs were so great that it didn't make financial sense to enter, that really barrier has been broken with competitive lending and high LTVs up to 75, even 80% under certain conditions. And because of that, that's created a larger level of transactions in that refinance space, which will have knock-on effects, and I think will be a strong performer. So you're correct, there is an imbalance and a positive imbalance because of the pent-up demand and the cost of borrowing coming down.
Rob, thank you very much for your views and analysis today. It's been really insightful. Go back to the three drivers and all of your analysis of the super prime market. So thank you very much for your time today.
Great. Thank you, James, and we'll see you all again soon. Thank you.
Thanks, everyone.